No questions are out of bounds. You're welcome to ask about the markets, about technical analysis, about indicators, about certain tickers, certain securities, whatever comes to mind. We're happy to go through them and answer any of your questions. I have a couple of prepared charts I'm going to sort of go through as we gather some questions, and then any questions that you have, just put it in the Q&A panel on YouTube, and we'll get to them shortly. So when I'm thinking of the markets, I've always talked about when the time I know we're in a bear market phase is when I have to keep drawing the chart larger and larger. And what I mean is bringing in more and more historical data. And I think a chart of the new highs and new lows on the NYSE and on the S&P 500 shows you why that is so important. So for a lot of us, our investment horizon, the time period that we were really paying attention to the markets, sort of the further we go back, there are less and less current investors that were, investing during these historical periods, and we go further to the left. And when you look at the chart and it's a 1-year chart or a 2-year chart, you're really limiting yourself to just this far right side of the market history. And the problem with that is you're not really including any bear market phases, right? You're just including, for the most part, a cyclical bull market and a secular bull market all piled into one another. So where we're at now is uncharted territory, pun intended, for that sort of history. We need to look back at some historical bear market phases to get a sense of what this means and how this relates. So the sell-off that we've had, 30+% of a sell-off, has certainly extreme. It is not extreme by historical standards in terms of the amount. What is extreme is the amount of time that it took to actually hit that. It went very, very quickly. And usually in a bear market phase, that sort of sell-off takes months, if not a year or two, and we did it in a couple of weeks. So it's certainly been an increased volatility, increased steepness of decline. But if you look at the new lows, so for example, on the S&P 500, at the worst, we had about 32, 320 of the S&P names, so just over 66% of the S&P making a new. This was, I think, on the big sell-off last week, if I remember right. And if you look back, the only other time in the history that we've tracked this indicator is back at the '08 market sell-off, right? Now, what's important about this, and I think this is why this is so key, that extreme blowout in breadth did not happen at the market bottom in February, March of '09. This actually happened on that initial big push over. So there are some differences here because leading up to the sell-off, we've been in an uptrend over the last year. In 2007 to 2008, we actually were in a pretty steady decline before we really capitulated, started really aggressively going lower. That's when we had the, horrible name, but the puke out in breadth, a real negative move in breadth was sort of that initial thrust downwards. That's one of the many reasons why I feel like what we're seeing right now is an initial move. It's not the end of the move. We're not looking at the '09 bottom here. I think we're more in the sort of fall '08 period, which means you're going to have reaction rallies that suck a lot of investors in. Then we have further legs down that get all of those investors that bought in even more trapped, even more negative, and it gets a little bit frustrating. Chart number one to sort of pay attention to. Chart number two, also sticking with breadth theme, is looking at the percent of stocks above their 200-day and above their 50-day moving average. Now, through yesterday, we had just about 4% of the S&P remaining above their 50-day moving average. Put another way, 96% of the S&P below their 50-day. Less than 10% remain above their 200-day. So very few stocks that remain in that condition. It's another reason why I think this initial sell-off that you had, if you look at the pink highlighted figures, so another sort of piece in that sort of bear market thesis that I've been talking about the last couple of weeks was this sort of big sell-off down when the S&P broke down through the 200-day. We broke down through that key 50% level. And in the previous sort of bull market cycle, if we could remain above 50%, if at least half of the S&P names would remain above their 200-day, it ended up being more of a buyable pullback within the longer-term uptrend. But you can see that when the indicator broke down through 50%, that lines up more with the big sell-offs. And none of these line up with the end. They don't line up with the bottom. They line up with that first move down, and the bottom came later, right? And so that's, again, why I feel like we're still in that situation where we see some potential further lows down here. One more chart, and then I'm going to get to any questions that come up. And again, just put them in the Q&A panel there to the right on YouTube. Last thing I want to point out was just from an asset allocation perspective. I did a presentation of the CMT chapter here in the Seattle area in mid-February. And at the time, I remember commenting, everything is going up. And it is rare that if you look at all five of these, the S&P, crude oil, gold, bonds, and the dollar, all five of them were in an uptrend the second week in February. And I remember thinking, that is unsustainable, right? Well, at least one of these has to change, right? They're not going to all move together. So if you fast forward a couple weeks later, you had that differentiation, right? So bonds held up, gold held up, and everything else kind of came down. So stocks came down, oil continued its move down, the dollar even weakened. Now we've had yet another inflection point. The picture has changed a little more. So now you have bonds that are in a bit of a downtrend, gold in a bit of a downtrend, stocks remaining in a downtrend, oil continuing unabated, and they just announced some trading curves for oil because of the volatility that we've seen. So if you look, only one of these five has continued or has now reversed back higher, and it's the U.S. dollar. And so that has implications for U.S. versus non-U.S. And in general, U.S. stocks are probably going to outperform global stocks as long as that pattern continues. That's sort of the traditional methodology. Also, usually has implications for small caps versus large caps. I'm questioning how that's actually going to play out here, just because all companies are sort of tied up in the coronavirus aftermath, and not even the aftermath, but the meat of what's happening right now. So I don't know if a stronger dollar is really going to make a difference for cap tier movements relative to what we've seen in normal environments. Thanks for the question. Do I know of any historical market data on triple witching days, one of which happens? It's a really good question. And actually, when I interviewed Jeff Hirsch from the Stock Traders Almanac, he and his father Yale Hirsch have always done such a good job of capturing triple witching days and even quad witching days. So you have single stock futures that expire, and he asked me in particular, "What do you think of quad witching days?" You may not know that single stock futures exist, and I would tell you most investors probably still don't. So I don't think quad witching day means anything meaningfully different. But triple witching is an interesting one, and that's where a lot of futures have to roll over. You have to roll over; they all expire, and so there's a lot of fluctuation. In general, that tends to be sort of a positive uptick for markets. And again, the challenge I have with that right now is that it's not. This environment is sort of a 5, 6, 7 standard deviation type of environment in terms of the volatility, in terms of the macro forces, the artificial supply and demand we're going to get with Fed easing, with presidential actions, with Congress, and bailout packages and all of that. So, thinking triple witching tomorrow, that's going to mean something. I think almost going to be a non-issue for a lot of investors, to be honest with you. But if you look back at the history, I think Jeff Hirsch has done better than anyone at trying to capture those sort of historical patterns. With no further questions, I'll just leave you with a chart of the S&P 500 as a reminder. From my perspective, we've talked about the 2350 level for a while. I think one of the biggest hurdles that the bears would have to overcome, as if they need anything. I think they've been validated by now, probably, but I think that 2350 level, we've talked about that for a couple of weeks as we've sold off, and that lines up with the low from December 2018. We're there now. We tested it, broke below it yesterday, closing above. Today, we broke back below it, but seem to be closing above. So as a support level, that certainly seems to be holding. I think a break below 2350 signals the upcoming much further losses as a potential. This correction is going to take time, and it's going to take more price, I would think. And bottoms are not an event; they're a process. So I think that's what I would leave you. Fine. Sorry, one final question. Do I think it'll be a U-shaped recovery or L-shaped? You didn't even give me the option for V-shaped. So that tells me, I think your question is softly aiming at an answer. That's a great, well-phrased question. I think it's going to be probably an L-shaped event for a while. I think once things sell off, I know we'll have volatility. So there are going to be swings that feel very V-shaped. So you will have big up moves of 5 to 10% and big down moves of 5 to 10%. Once things stabilize over the period, I think what happens is you have a lot of volatility, but the market stays in a sideways direction. So remember, the market can go up, market can go down, or that third direction is the most frustrating, which is sideways. And that L-shaped period, it's not really a recovery, it's more of a stabilization. And I think that's what tends to happen. I'm not seeing signs of that yet. I'm still seeing the capitulation, the impulse move down sort of characteristics, just looking at breadth and looking at momentum. But well-phrased question, Niraj. Thanks for that. Folks, that's our YouTube live Q&A for a Thursday afternoon. Thanks for joining us for it. You can see me on my closing bell, show the final bar every weekday, 4 p.m. Eastern, 1 o'clock Pacific. Charts TV. We're going to have a great series of guests and talk about some of these themes after the close. So I'll hope to see you there. Thanks a lot. From StockCharts.com in Redmond, Washington, I'm Dave Keller. Stay safe. Be well. Bye-bye.